Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
The central paradox of Ocean Power Technologies, or OPT, is probably the most acute divergence we're seeing in the microcap maritime sector right now. It's like we're watching operational rocket fuel colliding with a financial black hole. On one hand, you have a veteran company that has successfully pulled off a really critical strategic pivot, and it's achieving massive market validation. But on the other hand, the equity is just being utterly annihilated.
It is, but I would argue that technical reality is just the market acting with, well, a chilling rationality. The pressure here is structural, it's not emotional. As of late December 2025, the short interest stood at what, approximately 16.4 million shares? That massive short position isn't just a bet against the company's success, it's the inevitable outcome of how OPT has chosen to finance its own existence.
I see why you're emphasizing the structure, I do. But structure can only repress value for so long when the fundamentals are changing this dramatically. This isn't the same capital-intensive, pure wave energy R&D shop it was a few years ago. The CEO, Dr. Stratman, he successfully engineered this pivot away from pure generation and toward maritime domain awareness, MDA, and power as a service. And this move, it's capitalizing on urgent geopolitical needs in the blue economy, and it has delivered hard results. We've seen the backlog growth jump by up to 300% year over year, hitting around $15 million by late 2025.
And that is a brilliant operational feat. I'll grant you that. Absolutely.
So the question today is this. Is the equity market rationally pricing OPTT based purely on its destructive capital structure and severe dilution? Or is it irrationally ignoring the fundamental value created by this strategic pivot and the proven multi-million-dollar market demand? I'm asserting that the fundamental success, the technology, and the market wins will ultimately prevail once this financing bottleneck is resolved.
And I come at it from a completely different angle. I think the financial mechanics of dilution are an inescapable overriding factor that doesn't just dictate the price today, it establishes a structural ceiling that makes any long-term investment in the common shares an existential gamble. The structure is the reality, the backlog is for now just potential.
Well, my position is that the operational success is merely being suppressed by temporary, though I'll admit severe, financial headwinds. Look, the pivot to MDA and PAS is a brilliant chess move. They essentially moved from being a niche, highly capital-intensive battery charger company to an intelligence provider. They are now selling sophisticated data and surveillance in geopolitical hotspots, a space where national security, frankly, matters more than quarterly profit reports.
The problem is that national security payments are rarely on time.
But the market proof is there. That $15 million backlog is undeniable evidence of product market fit. These aren't just, letters of intent. These are secured contracts, including with government entities like the U.S. Navy and the Coast Guard. That validates the entire strategy and the tech stack. The WAM-V autonomous vehicle combined with the Power Buoy platform, it's real, tangible value. And what's more, institutional coverage reflects this confidence. You have firms like H.C. Wainwright maintaining a consensus price target of $1.50 per share. That implies an upside of, 375% from the current price? That's a professional valuation based on the underlying IP, not just retail hype.
Okay, but that institutional target is an assessment of what the shares should be worth in a financially healthy company. But this company isn't financially healthy. The market is reacting, quite rationally, to the brutal financial engineering that's already taken place. Since they started relying on these toxic convertible notes, the number of shares outstanding has practically tripled. It's ballooned from roughly 61 million to nearly 190 million.
It is a painful realization.
Painful is an understatement. That's a massive 67% dilution. It's effectively slicing every existing shareholder's pie into 3 smaller pieces. This dilution creates a structural ceiling that the backlog alone just cannot breach. And that persistent short interest, it's not just bearishness, it's a mechanical machine driven by what the industry rightly calls death spiral financing.
We should probably unpack that death spiral concept clearly, because I think a lot of people have heard the term but don't know the exact mechanism.
Absolutely. Okay, so imagine the company needs $5 million immediately. They go to a debt holder and they give them a convertible note. This note lets the holder convert their debt into shares at a fixed discount to the current market price. Let's say it's a 10% discount. Now, the arbitrager holding this note knows that the moment they announce they're going to convert, the stock price will probably drop because of the new share supply. So to lock in their profit and hedge that risk, they immediately short the stock before they convert.
So they're selling shares they don't actually own yet?
Exactly. Then, once the stock drops, they convert their discounted note into actual shares and use those new shares to cover their short position. It's a guaranteed profit. And the net effect is just this relentless selling pressure that's completely disconnected from whether the Navy loves the WAMV system or not. The financial structure actually requires the price to fall for the note holders to maximize their arbitrage. It's a self-reinforcing gravity well.
But that gravity well is fueled by the company's need for cash, and that brings us to the core of it all. The inevitability of dilution versus the reality of backlog conversion. You're focusing on the valley of death, the cash gap between signing a contract and getting paid. I'll concede, government procurement is famously slow and lumpy, and that $11.7 million in cash is, frighteningly low.
Frighteningly low doesn't even cover it, given their expenses. We need to look at the cold, hard math of their burn rate. Operating expenses are sitting at $8.7 million a quarter. That translates to a cash drain of roughly $3 million every single month. With only $11.7 million in cash on the balance sheet, their runway is what, 3 to 4 months max? They are guaranteed to need more money before that $15 million backlog converts into cash.
I agree, the liquidity situation is precarious. But the recent revenue miss, that recognition of only $0.4 million for the quarter, was directly tied to temporary external factors. We had the U.S. federal government shutdown, timing disruptions with hardware deployment. It pushed revenue recognition into the next quarter. These are logistical hiccups, not failures of technology or market demand. The market wants the product.
They are logistical hiccups that an undercapitalized company simply cannot afford. You're arguing the backlog proves product market fit, and I agree, it absolutely does. The market clearly wants these MDA solutions, but the immediate cash position ensures that while they're waiting for those slow-moving government checks, the company will be forced to keep tapping that convertible note market. And this means any fundamental value created by that $15 million backlog gets immediately erased for common shareholders by the tripling or maybe quadrupling of the share count. The success benefits the creditors while shareholders carry all the risk.
I think the market is subtly recognizing the intrinsic value of the pivot, though, even if the share price doesn't reflect it because of the share count inflation. Look at OPT's market cap, around $67 million. Now compare that to its pure-play wave energy rival, EcoWave Power, which trades at a much lower $33 million market cap.
And why is that relevant here?
Because that difference in valuation suggests the market implicitly values OPT's data and defense niche, the WAMB capability, far above the pure energy model. That $67 million figure represents the valuation of the total business, the IP, the relationships. Even if the price per share is low, the enterprise itself is valued significantly higher than its peers. This confirms the pivot worked.
That distinction between share price and market cap is meaningless to the retail investor, who just watched their ownership stake get cut by 2/3. And let's go back to the short interest, because this is where the market structure really triumphs over operations. You suggested that the technicals, the shrinking availability of shares for borrowing, suggests the easy money on the short side is gone.
That's right. The availability of shares to borrow tightened up late last year, suggesting an inflection point where bears might struggle to maintain their positions, and it drives up the cost to borrow. This suggests the structural shorting might be reaching its limits.
I hear you on the technical tightening, but that metric kind of misses the forest for the trees. It fails to address the purpose of the shorting. Because this is arbitrage, not a directional bet, they don't really mind the cost to borrow rising a bit. They're just using the short side as a hedge for their debt position. The trade is secure. It's mathematically decoupled from corporate operations. The share count is the only factor they care about. And as long as OPTT needs money, the supply of new shares is relentless. The stock isn't falling because the company is failing, it's falling because the financing structure is designed to force the price down to guarantee the note holders their profit. That's the genius and the tragedy of the death spiral.
But if the underlying business success is undeniable, if those Navy checks start landing in big chunks, eventually an institutional anchor investor will see this colossal valuation gap and step in with non-dilutive capital and short-circuit the whole debt mechanism.
But where are they? That lack of an anchor investor is exactly our third point: institutional credibility versus retail volatility. Institutional ownership stands at a mere 9.5% in its mostly passive index funds. They don't care enough to defend the floor. There is no large institutional player with 10 or 15% ownership who is going to put their hand up and say, "We will stop the bleeding."
And why does that concentration of retail investors, over 90%, matter so much?
Because the stock is just less susceptible to emotional volatility. Retail investors, generally speaking, are less likely to model complex cash flows and more likely to trade on emotion. And worse, the high dilution created this enormous amount of overhead supply from trapped longs, investors who bought shares at $2 or $5 before the pivot.
The old shareholders.
Exactly. Every single time the stock tries to rally, these trapped longs see a chance to just break even, creating this constant selling pressure that makes any sustained momentum nearly impossible. The stock has to fight its own history just to get back to $1.
I understand that dynamic, but let's re-examine the institutional side from the perspective of management credibility. Dr. Stratman, the CEO, is viewed by the analysts who maintain that $1.50 target as a highly competent operator. I mean, he successfully executed the pivot. Securing defense contracts from the Navy and Coast Guard requires professional credibility and operational excellence that is completely separate from the volatility of retail trading. That analyst target, despite the penny stock status, is a professional calculation of the core IP's value.
Well, that's a bet on immaculate execution. If the technology is genuinely this critical, if these MDA solutions are truly indispensable to national security, why hasn't a major defense contractor like Lockheed or Raytheon bought them out of their misery already? Doesn't that lack of a takeover or major strategic investment signal that the liquidity risk is so profound that even the big players are waiting for the inevitable bankruptcy?
That is a very probing point, and it does reflect a profound liquidity challenge. But I'd argue the opposite. Institutions often wait until the point of maximum distress to step in. The fact that the company still maintains that $67 million market cap, that it secured contracts, that its CEO made small open market purchases late last year, it all signals that management believes the company can survive this liquidity crunch and emerge stronger. The price is set for distress, and institutional investors are often looking for the highest possible returns on the highest possible risk. This is the definition of that profile.
Wait for institutional salvation. The company has to raise money now, and that forced selling is what will continue to erode the capital base. You're betting on the management team to execute a flawless, non-dilutive pivot in the next 90 days. I'm betting on the laws of mathematics, which state that if your cash runway is 3 to 4 months, you are forced to dilute, and the market knows exactly what comes next.
To summarize my perspective, OPTT is fundamentally a viable, growing business. It has real technology, a proven strategic pivot into critical national security sectors, and a record backlog. It's essentially a viable enterprise that's trapped in a classic liquidity bottleneck created by this high-interest, variable rate debt. If the company secures a single non-dilutive event, a big government grant that speeds up the cash cycle, or a strategic institutional equity injection that bypasses these convertible notes, the valuation gap to that $1.50 price target closes, I think, instantly. It would validate the entire fundamental thesis.
And to summarize mine, until the company solves its immediate existential liquidity problem, that dangerous 3 to 4 month cash runway, and secures financing that lets it escape the gravity well of this debt, the structural shorting and dilution will just continue. Operational success, however impressive the pivot, will simply serve to benefit the creditors and the arbitrageurs far more than the common equity holders. The mechanics of the death spiral right now ensure that growth in revenue only accelerates the destruction of shareholder value. The 70% loss, the 32-cent share price, those are rational reactions to financial structure. not ignorance of technological potential.
So the decision for the investor ultimately rests on one calculation. Is the operational success in maritime domain awareness strong enough to eventually break the structural gravity well created by its urgent need for capital? Or are the financing mechanics truly inescapable under the current market structure?
It's a profound test of whether value can emerge when structure dictates destruction, and that is where we'll have to leave the debate for today.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.